Welcome back. Well, let's put the focus now on the recent RBI actions on financiers, with the latest coming in on both IIFL Finance as well as JM Financial Products. Now, the RBI has asked for special audits to be conducted on these two entities. And remember, this flows from the earlier move when the Reserve Bank of India had stopped IIFL Finance from taking any further sort of steps in its gold loan business. Basically, that was shut down with the immediate effect. And ditto for JM Financial Products, loan against share business. We've got two experts of the BFSI space to give us some more perspective on this heightened scrutiny that we're seeing from the regulator. Sanjay Doshi, Partner Financial Services Advisory Leader at KPMG India, is joining in. And we'll also have another guest in just a bit on this. Sanjay, thanks so much for being with us on this discussion. What do you make of things? Because in the recent times, we've seen the RBI get extremely active with respect to individual corporates, individual BFSI players. It started with Paytm, then IIFL Finance, JM Financial Products. And now what we're hearing is that there will be a special audit in some of these cases. How would you read the news of this special audit?
So, see, effectively, RBI definitely is very worried and taking proactive steps, especially in some of the lending areas, lending where there are a lot of retail loans. Personal loans is one of the big areas, and you've seen actions or regulations really coming up in those areas. And also areas where they feel that there can be potential evergreening, or the collaterals and the process around verifying the collaterals or the KYC is not done properly. And especially in gold loans, how the quality of the gold has been measured by NBFCs or banks, and also the way the auction processes gets conducted. So it's more effectively really getting ensured that the processes are there in place, steps taken proactively, so no systemic risk really comes in the future.
So got that. They're looking to check for evergreening, if there is any systemic risk. Is this going to be a forensic audit, Sanjay?
I would call it a special audit yet. In terms of forensic means, okay, fine, there is an objective where you can see frauds really happening. So whether you can call it a forensic investigation, too early. It's more of a special audit where RBI is taking an independent audit to really understand the processes behind it.
And how long would an exercise of this nature take to complete?
Well, it really depends upon how deep they really want to go to. It can take anything around 4 to 8 weeks. Depending upon how deep they really want to go to and the kind of period, the scope really they want to cover.
So, Sanjay, what in the past, what do we know, and what can be the typical outcome? Could it just be, more from an observation standpoint, or could, special audits like these lead to, fresh curbs, more regulation? What does history tell us?
Well, you will see this kind of audits definitely something of the recent where RBI really is going, as I said, proactive. So yeah, one of the options or one of the outcomes can actually be changing in processes or more tightening of processes coming in. I think RBI has really laid down guidelines. One is to really ensure that, that particular audit which is happening on any company, that company is really following that process, the guidelines, etc. But in top, if they really find lacunas really happening where it's a market practice and that market practice needs to be curtailed, then definitely we'll see more regulations coming in.
You said that, while it's difficult to ascertain the total time duration of this exercise, but it may take 4 or 8 weeks. So it's safe to assume that at least for 2 months now, both IIFL Finance and JM Financial may not be able to resume the practices which RBI has clamped down on, right?
Well, that's something I don't know. I can't comment on what's really going to happen and what will be the action there from the company's perspective.
Okay. You said, the possibility that this may be a market practice also, right? The RBI wants to assess if this is a very company-specific issue or is this a market-wide practice that they want to bring under control. Have you done any early analysis on this particular point?
I don't personally have visibility whether they have done early analysis. Of course, there have been actions in the past. They get data. RBI today gets a lot of data, right? They get access to the portfolio data. They access to, in terms of the audit reports which the companies have, the internal audit reports, etc. So there can be some signs, but see, effectively think about gold loans, right? Gold loans where the purity of gold is definitely very important. and whether you really are seeing the practices around auctions. Are the auctions really happening at a very low value? Are the auction processes really conducted where the borrowers at the end of the day is a defaulter, right? But there should not be any kind of unfair practices really happening there. So gold loans definitely is one area where RBI just wants to ensure that things are clean. The borrowers also get a fair hearing on what's really happening on those collateral and on the auction. And at the same time, there should not be any over leverage or evergreening or lending against collateral. So for example, is the purity at 18 carat, but is it considered at 24 carat, and hence you really are actually giving it a very high loan to value. So some of those practices will definitely be under the radar.
Okay. So, that's on the gold loan side. The other issue which pertains to, of course, the other entity, which is JM Financial Products. I mean, that do you think is more a company-specific issue, perhaps, or when it comes to this model as well, loan against shares, whether this also calls for wider scrutiny, looking at overall industry practices?
So it's also happened in the past, right? Means if you actually see post or during the Lehman crisis also, you had actually see a lot of leverage finance happening on IPOs, happening on even buying shares, etc. And that point in time also, a lot of companies and a lot of NBFCs had taken losses. So today, whether it's a market practice, whether it's a per se company issue, definitely IPOs are on the upswing. A lot of financing happening behind the IPOs or for the IPOs. So is there any kind of wrong practices really happening there? This will be definitely a case where we'll figure out based on the audit. Can't say whether it's per se a company or per se a market.
Sure, yeah, I think absolutely we do have to wait for the outcome and see what more the Reserve Bank has to say. Abizer Diwanji, partner and national leader of financial services at EY, is also joining into the conversation. Abizer, great to have you on. So, we've been asking Sanjay whether the street or investors or stakeholders need to be a little more concerned now that there is this special audit that the RBI has called for on these two entities. How should we interpret this new development?
No, again, I think it's the next logical step because RBI has actually asked them to stop the operations. And the next logical step would be to get in and appoint an external person to do an audit. What is to be interpreted out of this is I think RBI is increasingly getting more and more exemplary. So I think it's about the product and the process and less about those companies. Because I think these practices may be followed across, and that's why these companies would also be following them. But the idea is that when there is an audit done on some of these companies, then others tend to get more cautious about what they need to do. Everyone, in fact, is introspecting. Whenever I speak to other NBFCs, they're actually looking into their portfolios and figuring out what they could do better and what is not in the spirit of what RBI wants them to do. So I think RBI is coming down. But as I've always said, in one of your earlier talks too, that the larger issue is the way credit is flowing and where we are not really sure of the end use of credit. So you do gold loans, one doesn't know where the money is going. You do capital market loans, you don't know where the money is going. At the end of it, if it's a machinery loan, then one knows one's buying a machinery or a productive asset or even sometimes consumer assets. But when you do PLs or when you do secure lending against gold shares, one really doesn't know where the money is going. And I think that is causing a larger systemic risk to the RBI.
On Abizer, on the capital market standpoint, gold, you can still argue there's a collateral. And of course, it's the purity and the value of that collateral that in this one case is what the RBI was trying to sort of, check upon. But on the capital market side, are you expecting any further regulations, maybe more sort of checks and balances, more curbs, perhaps in the coming days?
There'll be a combination of RBI and SEBI. So RBI's concern is more on systemic risk and less on markets. SEBI would be more concerned on market manipulations. Is money being given to individuals to subscribe for shares, which is then dumped into the market on listing? So those kind of issues and whether issues are being artificially made to succeed, those kind of issues is where SEBI will have a concern. So I think it's going to be joint regulatory action to some extent to figure out, where the end use of the money is going and are investors being duped in the bargain? Because, it's unfortunate in our country, we either have, the fixed deposit markets of the banks, or we have the equity markets, to gain money. And as investors seek more and more yields, given expected inflationary trends, people are tending more towards the equity markets, not really knowing the kind of risks they're taking.
All right, gentlemen, I think we'll perhaps wait by, and the coming days are going to, give us some more cues and clues to figure out what's happening with lending on the NBFC side. Thank you for joining in.